All right, we are live for the midday Mike and Mario show. Excited to be back for the first Friday of the new year. So, Mario, how you doing, my friend?
I'm doing well, Mike. Nice to see you, and happy New Year to you and all the viewers.
Oh yes, yeah, same to you, my friend. Man, so lots of things worth touching on. I guess primary subject matter this week happens to be the Fed. Then we got Kazakhstan. Then we have the energy crisis. So lots of stories to touch on. And in my personal opinion, I think the next 90 days is going to be very interesting to say the least. If all this Fed taper stuff actually fulfills itself or whatever, we'll see. But other than that, how do you want to kick off today? Today's live stream.
I guess we could talk about Kazakhstan because it kicked off over there a few days ago,
Yeah.
and I just thought, oh, it's just because of energy prices going up. But then I put two and two together,
Hmm.
and I actually referenced one of my old videos, one of my first videos
Yeah.
from November 2015, where I spoke about geopolitics.
Yeah.
And then the other thing I saw is that in the beginning of the week, an article in the Telegraph talking about Germany, how the
Hmm.
new chancellor there, the new government, is moving closer, could move a lot closer to China.
Yeah.
China is the biggest trading partner of the EU, and Germany is does a lot of business in China. I saw that the this new chancellor used to be mayor of Hamburg, which is the
Mhm.
biggest port in Germany, and they do a lot of trade with China. And then all of a sudden you get this thing kick off in Kazakhstan. And what's
Mhm.
that got to do with Germany? Well, I think it's got to do with the One Belt, One Road initiative.
Mm.
If you could
Mhm.
bring up, if you do a map of Asia,
Yeah.
an image, and you see that Kazakhstan is like right smack in the middle of Asia. It's right
Mhm.
smack in the middle of the old Silk Road, which is
Yeah.
still really important. It's a country that is probably as big as Western Europe, and so I think there's a lot more going on in Kazakhstan. I saw
Mhm.
that the Chinese government and the Russian government are helping out the government there, and that
Mhm.
the Americans and the British are criticizing that. So I think, I can't prove this, but I think it's some kind of open society triggered
Mhm.
uh, uprising over there. In the West, if you look at the newspapers, they say, oh, they're fighting for democracy in
Mhm.
Kazakhstan. But when people protest here in the West, like they did last year in Washington, D.C. or whatever, they call them like the T word, or they call them conspiracy theorists. But
Right.
in Kazakhstan, they charged into the parliament building or
Mhm.
whatever it was, uh, and while they're called they're fighting for democracy. So I think there's a lot more going on there. I think it's like a Hail Mary pass
Mhm.
by the crowd who control the petrodollar. And
Yeah.
who's that crowd? Well, it's the Anglo-American banking establishment, I would say,
Yeah.
the globalists.
Yeah. So when I saw the whole Kazakhstan eruption earlier in the week, the first thing that came to my mind was how timely to have another civil unrest event that is now allowed to get mainstream attention. And it has a lot to do with, the narrative they fed us was inflation, and so I noticed that I think their gas prices was 28 cents. It was 28 cents a liter, and it went up above 44 to 50 cents a liter. And they were using that as saying that inflation is so bad, that's why people are unrest and whatever, whatever,
Yeah.
whatever. I'm thinking like, okay, that's interesting, but they also a naturally oil rich country. I think I saw something about up to 2 million barrels a day
Oh,
or
they're
something.
the 19th biggest oil producer.
Right. And
Uh,
then uranium, I mean, I think 43% of the world's supply comes from. I'm thinking like, man, this looks like a little Soros type of event. Like this has to be something where somebody's going to profit. And then I thought about the fact that right now they want an energy crisis so that they could, basically pump up inflation there as well as basically freeze people heading into Europe. I'm like, man, this is just too timely.
and if you can have the West move in there and have the sphere of influence in Kazakhstan,
Hmm.
I mean, that would scupper a lot of this One Belt, One Road
Yeah.
uh, initiative. It would scupper this Shanghai Cooperation Agreement.
Yeah.
Yeah, so but I think it's gonna fail. I
Mhm.
don't think it's gonna play out because, the Chinese and the Russians are too yeah, they're too on top of things to
Yeah.
let that happen, and,
Yeah, and then I wanna just bring up this article real quick. You mentioned about, the One Belt, One Road initiative. I think that's crucial. Like, that's something that I didn't get there yet as far as putting that piece of the puzzle together, because everything is intentional. Nothing is accident at this point. And so we'll see how this plays out. But definitely energy
yeah,
is gonna be the key behind all that and who controls it. So I
yeah.
think the West want their cut out of all that.
Maybe we could, look at that question we had there,
Good deal.
uh,
Let's jump on that
first
one.
que
All right. And
yeah.
also, I forgot we are streaming live. So for those that are tuning in, as always, hit the thumbs up button, show your support for the channel. Feel free to thoughts, ideas, suggestions. We'll definitely try to jump on them. Got a couple more subjects here, but let's get to the first question, which was a pre-question for Mr. Keenan. He says, how does the Fed reducing bond purchases raise rates? And then which rates? Is the action different from raising the Fed funds? Happy Friday. What do you have, Mr. Mario? What are your thoughts on this?
Yes, I worked, of course, in the bond markets for over 20 years.
Mhm.
So I'm familiar with the mechanisms that central banks use, even though back in the 90s, no one used to do QE.
Mhm.
But what the Fed would be doing by reducing purchases of bonds, it would mean that there would be less demand for bonds.
Mhm.
So, um, bond prices and yields are inversely related. So if I went into the market and bought $1 trillion, if I could create $1 trillion out of thin air and buy the 10-year notes or 10-year bonds, that would drive up prices and yields would go down.
Mhm.
So that's what the Fed's been doing with the QE. They've been buying loads of different bonds,
Yeah.
different maturities, driving up the price, driving up the yields, and yields are what the secondary market where people trade bonds, they use that as an indication for interest rates. So if the 10-year yield is at 2%, and a corporation wants to issue bonds, they'll probably have to pay over 2%. They'll pay over 2% depending on their credit rating. Let's say
Mhm.
a AAA company will have to issue and pay investors 2.5%. But if the
Yeah.
Fed stops buying the 10 years, there will be less demand. And when there's less demand, prices usually drop and the yields go up. And then yes, that's how it affects interest rates. And then corporations, mortgage borrowers, they all have to pay higher rates.
Mhm.
And the Fed funds is it's easier to uh,
Control.
control and communicate to the market because the
Yeah.
Fed it's a short-term rate. It's the overnight rate that the Fed charges to banks that come to the Fed window, the
Mhm.
Fed funds rate. Or no, actually it's the overnight rate that banks in the Federal Reserve
System.
system lend to each
And to
other.
each other.
That's what
Yep.
they charge. So it's, the Fed can set the target. It's a short-term rate, but with the QE, it's more difficult because it's got all you have all different maturities and it's the biggest market in the world, the bond markets.
Mhm.
And yes, the Fed won't know exactly where rates are going to go if they pare back on the QE. But if
Yeah.
anything, they said they're going to start tapering, and then what that means, that doesn't mean they're going to stop buying. They're still buying, but at a slower rate.
Yeah.
And I did a little bit of digging yesterday because the Fed published its balance sheet
Yeah.
data yesterday. Every Thursday they do that, and I calculated from the beginning of December to the beginning of January this year, they did
Mhm.
115 billion in QE, which is only 5 billion less than the original 120 that
Right.
they announced in 2020. But they're supposed to have tapered by 30 billion. They're supposed to only be buying 90 billion. So
So let
are
me
they
ask you
really
this question. So, refresh my memory. When did they first announce that they were going to start dialing back? Because I thought it
in
was,
November?
uh-huh.
They announced in November that they're going to do taper by 15 billion, which meant that they were going to only be buying 105,
Hmm.
right?
Hmm.
But as I said, they bought 115, which is 10 billion more than the 105.
Yeah.
And then in mid-December, they said, "Oh, actually, we're going to double the amount. Instead of tapering by
So the 15
15,
is
we're
going
going
to be
to taper
30.
by 30." But from the data, it looks like they've only done 5 billion of tapering.
Mm.
Of course, uh, the proof will be in the pudding of the January data, and we're going to
Yeah.
have to wait until the beginning of February to see that, to
Yeah.
see if they only do 90 billion. Then
Yeah.
I'll say, okay, that's
Now, so what's concerning is that if they have already reneged, lied on their promises by throwing out fake figures as to what they're going to try to do, why all of a sudden now are they trying to do it all? And so this is where that whole triple threat of them trying to taper, like, it's one thing to ease into it, but they're trying to literally
yeah.
cut off all accommodative policies and pull
Well,
back on what they've already put out there this year. Like, so of course I got my suspicion. I kind of figure out how it's going to play out, but
well,
it's
they're
just
not really. They haven't done it. The
yeah,
Fed
yeah,
they like to talk about it. They're threatening, and
yeah.
I think the reason they're doing that is because they realize that people are starting to ask a lot of questions,
Hmm.
not just people like you and me in the who have been Fed critics for the last 10 years at least.
Yeah.
But mainstream investors are saying, how can we have 6.8% CPI? How can we have PPI at 10%, GDP at 5.6, unemployment rate at
Mm,
3.9, even though the non-farm wasn't very good today? How can we
yeah.
have that and rates still be at zero and you guys still printing money? So they send in Bullard from the St. Louis Fed yesterday to say, "Oh yeah, we're going to start running off the balance sheet very soon." But I saw a tweet. I forgot who it was. And they said, "Oh, I think it was Sven Henrik. He's the
Uh-huh.
Northman trader. He's
Uh-huh.
really good to follow on Twitter, a Northman trader." And he
Yeah.
said the Fed is now talking hawkish, but when the market corrects 10%, they're going to come out with their dovish bat and stop that. They're just playing games. And if they do what Bullard said yesterday, if they really do that, then they're gonna bring the whole thing down in
Yeah.
an election year. And I think Jay Powell would probably be sacked. So I'm not too sure. It's difficult to say what's going on, but at the same time, as we speak today, we're seeing the bond market, the yields go up even more. This has
Hmm.
been the story this year. We jumped in the first day of the year 13 basis points in the 10-year yield, and right now we just touched 180, which is the
Hmm.
highest level in almost 2 years. So that's not good. And yeah, the Fed's between a rock and a hard place.
Yeah, and then just to look at a couple other headlines here, that just shows the skepticism amongst the financial and economic realm. It says it's time to fight the Fed. Veteran strategist says the central banks won't risk a 20% drop in housing prices and 30% slide in stocks, or will they? So here's my suspicion: tinfoil hat, go far left field, because all this stuff is just too timely. They're stop accommodating the markets. They're talking about raising rates and reducing their balance sheet. We know they couldn't do it from prior 2019 timeframe. It didn't work. And so I think personally, somehow, some way, a signal was given, and now's the time to really kick in on the Great Reset agenda. Like, I think whatever is on the table, like this year is going to be a defining moment for the global monetary system in general, because I like to pinpoint all the events happening in China. It's getting out of hand over there. And if it's getting out of hand over here, what better time to bring both of the cards down? The ultimate debt jubilee. Let's reboot, let's start it over again. All that stuff is ready to go. And then also, the whole crypto stuff is okay. So the ISO, did I see an article about the American Bankers Association,
I
and
saw that.
how
Yeah.
basically the banking system, the banking structure here, they're okay with implementing the ISO 20022 by next year. So everything is starting to play into their favor of issuing
Mm.
that CBDC. And I think the ultimate event could happen this year. And so another little far left, rant is that
Yeah,
if things
I mean,
unfold the way that I think they will, we may not end up having a November election because we might be in some type of national emergency state for real on a monetary side of thing. So just yeah, and then of course war is the
I,
last thing that could
yeah,
fall.
I'll give you my counter argument.
Yeah.
Um, I would say that maybe they are trying to like stop. They're trying to like wriggle out of this situation,
Mm,
trying to convince investors and people, the public, that the economy is doing great and that
mm.
interest rates are going up because the economy is doing well, and that the Fed will be able to do all this. But like, or and they could
To do what? Like,
and they
are
could
they trying to
lose
buy
control,
time?
and they could lose control because um, I guess, would the Fed really want to risk the, letting everything implode, uh, and like not fulfill its supposed mission of full
Mandate.
employment and stable prices, and then uh, you know uh, Jay Powell was just nominated last month, I think,
Mhm.
or in November. They renewed his post. There was like a close call. It could have been Brainerd,
Yeah.
and he got the nod. So I think with a midterm coming up,
Mhm.
I don't think he's gonna politically. It would be, he could lose his job if he lets everything implode. But I could
Mm.
be wrong. You never know with these
So
people,
here's the thing. So
and
what's
you could be right.
so here's so whether, and that's where I don't want to be right. I don't want to be right, but I have to be realistic and say that in my personal opinion, I don't think the Federal Reserve even has control of what's going on now. I think, of course, they're always reactive. And I was actually listening to this video, where is it at, from Mr. Gunlock, and he was talking about how, he was expressing his concerns as to how the Fed is already behind the curve. Now they're trying to play catch up. He's talking about, the recessionary fears of course, with short-term interest rates, already starting to pick up long-term, and all the the yield curve inversion situation, recession within the next I think the second half of this year. I'm thinking, like, so they already know that the game's up. I think now it's a
Yeah.
matter of trying to bring this
Well,
thing down smoothly rather than just
yeah.
completely lose control
It's
and the thing
interesting
goes
you
belly
you
up.
you spoke about the yield curve, because you sent me an article and I was reading it,
Hmm.
because if you get like an inverted yield curve, which means that the longer term bonds are yielding less than the
Yeah,
short term bonds,
yeah.
that's usually a signal of a recession. And some people are arguing that the Fed wants to unwind the balance sheet
Hmm.
because a lot of the bonds are more longer term. So that would help keep longer term rates high
Yeah.
and a signal that there's no recession. But that doesn't make any sense.
Hmm.
That's just like putting lipstick on a pig, saying, "Oh, look, the yield curve is not inverted. There's not going to be any recession just because we're manipulating. We're letting but I would think that the Fed does that, it would create a massive event, financial, economic events,
Hmm.
if they do it too quickly. Just to give the viewers an idea, when the Fed did its QE after the '08 crisis,
Hmm.
um, it only started running off the balance sheet, which means actually decreasing uh, the assets in 2018, 10 years after.
Hmm.
And now they think they can do it 2 years after the 2020 uh, crisis. I mean,
Hmm.
that's what they. Reading that article, the guys at J.P. Morgan and the Fed said, "Oh yeah, we can do that now because the economy is much stronger and so and so." Do you really think the economy is strong? I mean, um, we. I saw someone tweet that 3.1 million people in December lost their jobs because
Hmm.
the companies they worked for went bust. How can the economy be strong?
Yeah, and of course we're getting these numbers again, the payroll numbers, and so it's 199,000 is what is the figure that was given, and expectations I think of 400 and something, 400 and
Was
something thousand.
400,000, yeah, so it was
Yeah,
half of the expectation.
Right, and that's bad news all in of itself. And typically, when that type of stuff come out from past months, if I'm not mistaken, don't the markets tend to take a little dip and there's a sell off or something like that? But yet, no real response as of today. And so,
Yeah.
once again, I think it's all about trying to stay face
The
as best
other
they can.
thing the other thing the bond market would do on a number like that usually is
Hmm.
that yields would drop and bond
Hmm.
prices would go up because people would think, well, the Fed is not going to be as hawkish and the economy is slower, so interest rates will go down. But no, we're seeing uh, since the beginning of the year, first trading day, we're seeing nonstop rising in yields. We started the
Hmm.
year, uh, I mean, we ended 2021 around 1.51% in the 10
Hmm.
year. And right now we're at 180. So it's been like a, how can I say, a continuous rise. It's the
Yeah,
worst start for the bond market ever
yeah,
since they've been recording it in terms of prices going down and yields going up.
yeah. Speaking of which, here is a little article that kind of reflects that a little bit. It says sleepers bond traders face worst start to a year in decade.
Yeah, decade. Yeah, there you go.
So yeah, this is yeah,
The
very
thing is that we're not even near in terms of yields.
yeah.
Uh, let's say in the past, if
82.
inflation or CPI was running at 5 or 6%,
Yeah,
the 10-year yield would be at least 6, 7, or even 8%, and it's still only at 1.8.
yeah.
So I
Man,
mean,
man, man.
it's really
Upside down.
I don't know. It's not great.
Upside down reality.
That's why we keep stacking, right, Mike? Because we want to be
Exactly.
outside the system.
And to
Much
emphasize the
profitable.
importance of stacking, I want to highlight some interviews that I saw that paints a very dark and doomed picture. And that's why I said the next 90 days between now and March, when the Fed plans on doing what they say they're going to do, what could happen. And so Michael Pinto yesterday had an interview where he's talking about, he's expecting a 30+% market drop in Q2 with trigger recession, warns respected money management. So Michael Pinto, he's he's a stagflation guy / hyperinflation is coming soon. And then of course I can't not acknowledge Harry Dent, who's been predicting the 90% for the last 10, 20 years. But his demographic philosophy in the long run, I think will play out. But he's talking about a 90% crash this year. So between 30%, 90%, to me, those are just some numbers that could be right, could be wrong. So
Yeah,
anywhere in between those numbers are extreme,
yeah,
and that is going to be an ultimate shock to the system and the response from that. And so, as a result of that, here's the bad news. I do think that there's going to be a major sell-off, and so I'm hearing even some crypto people talking about an 80%, 90% sell-off. And then also gold and silver. I think they're going to try to dump the entire stack of futures contracts all at once, one last time to drive silver down. I mean, they can take it to. I don't know. Is it possible to take it to $6, $7, $8 on their spot price type of thing or what?
yeah.
But I can
Well, they
see it.
could, but it would be really hard to buy silver at that
You
real
wouldn't be
silver
able to buy
at
my. That's
price.
my point. So
Yeah.
right now, when you can actually find it, because I don't think that it's readily abundant as a lot of the retail stores online
Oh,
and your
yeah.
coin shops. They have inventory, true, but in a situation like that, when the world runs towards it all at once, all those businesses won't be able to sell it for what the
Yeah.
spot price will. They will have to double the premiums because of the
Yeah.
pressure on them. Whew.
I
Um,
saw an article, actually, someone sent me. I'm not sure if it's public, and I was
mhm,
able to get into it. Is the prediction by Byron Ween and another guy from
mhm.
Blackstone Group,
Yeah.
and
Uh-oh.
they actually see the stock market maybe dropping 20% at some point, but that it
Mhm.
would rebound because the Fed would like kickstart again. They see
Yeah.
continued inflation. That's Blackstone. They're quite,
Yeah.
they're
They're in the know. They're in the know, so
they're
they
in the know,
actually have
and
the
they
answer.
actually they said they see gold making a new high, going up 20% this year. So that's
Yeah,
it.
so
I just want to show the viewers here, if I can share.
go ahead, share your screen.
This is ARC, Claire Woods.
Oh,
fund.
okay. I was gonna mention that. Kathy Woods. I
That's
was gonna
not
mention that
looking
too. Yeah.
that's not looking very good, is it? I think because the Nasdaq has been the driver of this bull market and technology and everything. So this looks really bad. I
Mm.
mean, this looks like we're going to drop to where it was in 2019 very
So
quickly.
to piggyback on that, like, so I was listening to some commentators earlier this week talk about, Kathy Wood's decision on, buying, I guess, Roku or two or three. She went double down on two or three technology stocks that are not innovative.
Coinbase.
Right. It's just like, why? So the question was, why would she be putting that into her asset portfolio right now when given the trend of technology stocks having a little bit of a sell off? Did she know something, or is she literally like gambling with, millions and billions of people's funds at this current moment
Yeah.
when things aren't really in that, they're not trending in that direction in a positive nature? So,
Yeah. The thing is, she doesn't. Yeah, she's still getting her fees, so
mhm.
that's the
Oh,
thing.
yeah, she's good. She's good. Not her invest. So so as always, for those that are tuning in, throw out some questions, throw out some thoughts, and here's something here from Britver. If I'm saying that incorrectly, forgive me. But it says, what happens if they taper and inflation still go up like the 1970s? They may not have to taper higher than 2%.
Um, I think you mean increase rates because tapering is not really higher than tapering is like decreasing the amount of money printing or QE they do.
Uh-huh.
Uh, yes, and then after they finish the tapering, they stop. It means they stop doing QE,
Hmm.
and after that they will raise interest rates, and they're talking about raising it 2 or 3 times this year. Um, yes, and in the 1970s, when there was a lot of inflation, they started raising rates in 1977,
Hmm.
and actually inflation started followed the rate increases up until inflation was like double digits up until the early 80s.
Yeah.
So what raising rates does is increase the cost of credit. So if in an economy, it's even more based on credit today than it was in the 70s. At least there wasn't as much credit induced spending then I would say.
Hmm.
It would increase the cost of everything. So, yeah, I don't think the rising prices are going to stop. You could see a drop in prices of financial assets like ARC Fund and other things. But everything that we need to survive electricity, utilities, food, oil, gas. That's going to keep rising. I just saw Goldman Sachs saying that yesterday. Jeff Curry,
Hmm.
our friend Jeff Curry, the head of commodities from Goldman Sachs, said they think commodities are in a secular bull market.
Boom. Super. Yeah. Yeah.
So yes, I think it's very possible, and tapering is just the beginning. But um, the Fed is really they're pretending they're hawkish, and the mainstream media and the CNBCs of the world are going along with it, but they're not really hawkish. They're still very dovish.
Yeah, I want to acknowledge Mr. LBP real quick. It says, can the
Yeah,
bond markets overwhelm the Fed? Will they change rules to block exits? Can the bond market overwhelm the Fed? Can it overwhelm the Fed? What are your thoughts? I think, as of right now, because we have the reserve currency world, they can, they can directly
yeah,
start just swooping all those things up off the market like they probably are right
yeah.
now that we don't know about. So I don't think it overwhelmed myself, but uh,
I guess the Fed does own, I think, 8 billion. Is it or
trillion.
8 trillion
Trillion?
in
Yeah.
treasuries? Yeah, 8 trillion in
Yeah.
treasuries.
See, the numbers go so
Yeah,
big, we lose
and
sight.
there's the treasury. I mean, the treasury traded in public is not the 30 trillion national debt, maybe a little less. So they
Mhm,
do control quite a bit of the treasury market, but not all of it, and they don't control the rest of the bond market, which is huge.
mhm.
The corporate bonds, the mortgage-backed securities. Uh,
Yeah.
so, uh, uh, so what they could do is just uh, do a 180 and say we're gonna stop doing the tapering, we're actually going to increase the QE
Hmm.
or block exits. Well, the only way they would block exits would be to freeze, for example, put sanctions on China and other countries that have a lot of treasuries and
Hmm.
stop them from trading it. But that would be the end of treasuries, I would say,
Yeah.
because
Hmm.
it has to be a free, open market if the United States wants the dollar to be a reserve currency,
Yeah.
unless I think during World War II they froze the Swiss. Switzerland had a lot of dollars, and they were neutral, but they still froze their treasury account. But I don't think they're going to do that today. The only option they'd have is find an excuse to start while increasing the QE because they're
Hmm.
still doing QE.
Yeah. So one thing I want to mention is that I was looking on Twitter and I saw how a lot of financial individuals was talking about the correlation to life in general right now is all paired to the accommodative policies provided since basically the great financial crises and how they've attempted to, QE 1, 2, 3, 4, whatever we're at now, 5, 6, infinity, whatever, and how the housing market parallels this, very well. The stock market parallels this very well. Cryptocurrency market parallels this quite well. Our entire financialized lives parallels this particular graph here, and that's the balance sheet. And they're talking about tapering that. So in reality, I know they can't,
Yeah,
but
well,
if they
tapering would just stop that growth.
okay, so I'm talking
Tapering
about the
doesn't bring
quantitative
it down.
tightening. I'm sorry, the
Yeah,
tightening,
they're talking on running it off. Yeah, like making it go down,
right?
like they
So
tried there in 2018. Yeah.
and that means that not close to 9 trillion that exists. They're talking about removing that from the financial system. They provided as accommodative policies throughout the 10 plus years. They talk about removing it now, and the question is that removes currency from this from
Oh
circulation
yeah,
or assets from.
it would kill the economy.
It would
Uh,
kill the economy. So just
yeah,
the mere fact they're talking about it.
there's a clip from I think 2008 or 9, and
Hmm.
it's Ron Paul questioning Ben Bernanke at the time, who
Yeah.
was the chairman of the Federal Reserve, and they're talking about the Fed's balance sheet going over $1 trillion. Now it's at 9 trillion,
Hmm.
and Ron Paul said, "Don't you think it's a problem? Will you ever get back to where it was before the crisis?" Oh, he said, "Oh yeah, that won't be a problem. We'll just unwind the balance sheet." And
Right.
here we are 13 or 12 years later, and we're at 9 trillion. Looking back at history, when you go down that path of
Hmm.
hyperinflation, because that's what it is,
There's no
it's
return.
very hard to get off it. Like you said, all our lives are basically dependent on this because
Hmm.
it's not based on creating real wealth. It's
Right.
all based on funny currency created by the central bank and the banking system.
Yeah, and so this plays right into. So for those tuning in, definitely feel free to ask some thoughts and questions. I'm gonna jump on some. I see some thoughts out there. So this jumps on the importance of precious metals. I want to share this tweet real quick because I want to look at the graph a little bit and talk about activity. But here's something from Jeff Clark that he put up yesterday, and I was just noticing this trend here. It says the average annual silver price, fill in the blank. So 2019, 16, 20, 2020, $20, 2021, $25. And then I'm listening to people's response on 2022. So just given the circumstances, if they are able to maintain this narrative of everything is fine and still control the paper game of the metals, will we, fight safety $30 at best? But if they
I
lose
mean,
control in its entirety,
looking at the
uh-huh,
last 3 years, you would naturally extrapolate $30 average or so.
yeah,
But who knows? I think the $30 level is a key level, and if you look at the chart of silver, it
mhm,
looks like it looks quite explosive, even though we've had a frustrating consolidation for over a year and a half now.
yeah. So I thought that was worth mentioning because our all-time highs and everything else around us, except gold and silver, should be more food for thought as to why it is a strategic, systemically important financial hedge
Yeah.
against all this craziness. Oh man. Anyway, just gotta
And
laugh
the
at some
and the
things,
and the
man.
bankers, hate silver and gold as well, and
Right.
that's why they want you to keep buying the ETFs because they're not real. So that's why you should buy physical. That's my opinion. I'm not telling you to do
Right.
it,
Right.
but if
I
you
consider it
are
as
interested in buying gold and silver, uh, Mike and I think it's better to do through the physical, unless you want to keep the bankers in charge.
yeah. And I just consider it's kryptonite against the evil cabal. You know what I'm saying? It's their weakest
That's a
link.
good one.
So as of now, here's some price action. The fact we're in a green on a Friday is not too common, but I think we should
No,
celebrate this eight.
especially after non-farm payroll.
Exactly.
Yeah.
Oh my goodness. Let's jump into some thoughts and questions real quick, and then we'll get ready to dive back. Feel free to throw out a thought or idea. We'll jump on it and go from there. And speaking on another note, there's a lot of interest rate hikes happening around the world in emerging markets. Argentina went from 38 to 40%, even though they have 50% inflation. What else? Who else? I think
The Bank of England raised rates
Bank of
from
England.
point 1 to 0.25. Wow. Huge rate hike. Uh, who else is I mean, Brazil has been raising rates in
Yeah,
the
so there's
last
been a
couple
lot
of
of
months.
central banks deciding to raise rates at this current moment.
And I think Denmark Denmark
Mhm.
has raised rates as well. They're not in the Eurozone. They have their own currency.
Yeah.
So yeah, they have been raising rates.
Here's a question here from Mr. Aaron. It says, "Do you guys think the 10-year will reach 2% this year?"
This week, I think he says.
Oh, this week. I'm sorry, this week.
Uh,
Eesh, ee,
I think next week, but this week, we've got only a few hours left
mhm,
of trading. It is Friday. We reached 180.
mhm,
We went from basically 150 at the end of last year, so we moved 30 basis points in 1 week. So
mhm.
it's very possible that we could go to two next week, but not this week. It would be a little bit of a stretch, but you never
Yeah.
know.
Yeah. So yeah, that's the anything is possible. Here's LBP says Turkey lowered rates to fight inflation. Thoughts? Yeah. So Erdogan has gone against the grain. It's a different monetary approach, I think, because most other nations won't follow that same pathway. And so, of course, you mentioned several weeks ago that it's more to that story than we're being told. He's trying. I mean, he's fighting in the best interest of his country,
Yeah.
perhaps, to try to,
I,
you know,
I, yeah.
what?
I,
What do you think?
I think that's actually the Joe Biden School of Economics.
Uh-huh.
I mean, if you want to fight inflation, you have to raise rates,
Uh-huh.
not cut rates.
Yeah.
It's like the Democrats now are saying that you need a lot of infrastructure spending to lower inflation because we need more. Right? That it's the same BS. So no,
Yeah.
I think yeah, that's why he had to a couple of weeks ago he had to intervene and say that he would uh, subsidize
Mhm.
savings rates and for people that he would if the Turkish lira dropped in value more than the rate of interest that people got on their deposits, they would compensate them. And that's the only reason why he
Mhm.
stopped the lira from collapsing. But I don't think that's going to work. The
Yeah.
only way to stop inflation really is higher rates. And unfortunately, I think there's more to what's going on in Turkey. It is a little
Yeah.
bit geopolitical, but be as it may, they've got inflation, and
Right.
it's like the only way the Fed is going to stop inflation is through raising rates. But the Fed, of course, is different than the Turkish central bank because
Right.
they've got a lot more pedigree and credibility, so to
And
speak.
it's
Uh,
the world reserve currency. So
yeah, but I think they're becoming less and less credible, though.
yeah. Oh, so I think they already lost 100% of control. They're literally trying to steer this thing down without it crashing down. So here's a question to end on right here: how this benefit how to benefit from the crash, Osman? How to benefit from this crash? And so I think outside of course precious metals, from a financial standpoint, I think a lot of us don't really consider the energy side of things and how the supply chain, as I was talking about, the supply chain and the energy situation, especially here in the developed world, everything we used to is just in time. Just every Friday, the groceries get delivered, whatever. So the entire adjustment of our lives will be disrupted as well. So self-sustainability, which is hard to say for a city boy such as myself, but trying to figure out ways to reduce my dependency on the system, whatever that means. You know what I'm saying? So
Yeah.
that covers every aspect of our lives. So that to me is the best way to benefit from the crash, to minimize the amount
Yeah.
you have to lose from the crash. And so that's my little rant.
I think if we do have like a massive crash, because we had a crash in 2020 and they
Mhm.
salvaged it, but if we have another one this year, and it's difficult to say whether you're going to have it or not, I think the secret to benefit from this crash is to be the one that actually doesn't lose as much.
Mhm.
That's the kind of environment we're in, and but I also think that there's a value in tangibles in the commodity markets, because
Yeah.
if you look at metrics like relative value of the Nasdaq versus silver or versus commodities, uh,
Yeah.
commodities are haven't been as underpriced versus uh, like stocks for forever. So
Right.
I think even if the stock market corrects maybe 20-30%, doesn't crash, we might see a little bit of uh, even we see 5% of all that money that's been created since '08 move
Mhm.
into hard assets. It's going to be like trying to fit a garden hose into the Niagara Falls.
Yeah.
And that's why I think, like Goldman Sachs said, and I don't like Goldman Sachs, but I agree with them that commodities are in a super cycle. So I
Right.
think you could benefit from doing that. And just one more word,
Yeah. Yeah.
uh, don't get leveraged. Don't borrow to do this. I would say, because it could kill you. You could be right, but it could also destroy you because of the volatility in the markets.
Yeah, and this, to speak on the whole commodity cycle, super cycle that a lot of people are predicting, the reason that will be the case is because those are actual, real, tangible things that
Yeah,
we need to exist as a
that's right.
species.
Yeah,
And
it's
so
not just
everything that they've
yeah,
created as derivatives of that are all just paper, digital things
yeah,
that we give value to those things
yeah,
as substitutes for those things, but it's all about the real tangible things anyway.
yeah,
So
and all the valuations you showed a chart of the Fed's balance sheet. All the
yeah,
valuations of all the big tech companies, they're not real. I mean, there are
Mhm.
good companies. I'm not, but the
They've been
values are just like
artificially stimulated.
yeah, by 12 guys at the Federal Reserve.
Yeah, 12 guys. I think it's a couple gals on there, guys and gals.
Guys and gals, yeah.
Yeah. All right,
Sorry
let's
for
get it
I
down
was
back, man. I see
politically
some more
correct
thoughts.
there.
So I see some thoughts about Greg Manarino, but let's save those for another day. Well, anyway, for those that are tuning in, appreciate you guys for hanging out with us. Once again, get your weight up. This is going to be systemically important for your financial future and and generations beyond you, that you are protected in some capacity from a financial standpoint. And of course, ultimately, prayer is going to be your ultimate super weapon, because nobody knows what's ahead and how it's going to play out. But we got to have faith that things will work out for the betterment of humanity at some point moving forward. But Mario, be blessed, be safe. Any last thoughts you want to leave us with before we dial back?
Well, I couldn't agree with you more. Think long term. Think not just of yourself, but your family and going forward. Because I,
Mhm.
I think if you look at, and I'm not saying we want to be like these families, but you look at the people who have a lot of wealth, uh, they think long term.
Yeah, very true. They think well beyond the current circumstance. They think about the assets that their kids'
Yeah,
kids could use
yeah,
as
and
income
I think
producing tools.
with financialization, there's too much focus on quarterly earnings.
Mhm.
People focus on like short term.
Right. and just the whole model of investing in your portfolio. Now it's about trading and flipping things rather than buy and hold. That whole model has died out, and of course along the 60-40 investment portfolio side too. But anyway, people, we can go on forever, but we're not. Appreciate you for hanging out with us. Definitely Manico64 on YouTube, Rethinking a Dollar wherever you find me, and be blessed. Have a great weekend, and see you guys later. Peace.